All right, guys, a very common question we get, even in our patrons who subscribe to our software, is should I be investing in ETFs or stocks? Because they see me 100% stocks, but there's a big difference. I've got 8 or 9 businesses upstairs. I've got a lot of real estate. I've got so many different ways of making money that I don't need to focus on my retirement as much as other people do. I have a lot of things set up already. Now, so what's the difference? Stocks are individual companies, right? So a company goes public, Microsoft, you can buy their stock individually. You're buying Microsoft, MSFT, done. ETF is an exchange-traded fund. It acts like a stock in the sense that it's always trading, but what it does is it mimics kind of like a mutual fund. It follows a sector or an industry or some sort of idea, whether it could be an index like the S&P. For the ETF for S&P is SPY. For the NASDAQ is QQQ. Or you can do things like JETS. It follows the airline industry, right? So ETF is a broader way of getting access to a certain sector, industry, index, etc., at a very low cost. So a typical mutual fund will charge between 1% and 2% a year. SPY here is 0.09% a year. So it's way cheaper, 90+% cheaper than an ETF, than a mutual fund. And what's the point of that? Well, people don't realize that when your expected returns are 9 to 10% a year over long periods of time, and you're paying 1 to 2% a year, you don't realize the millions of dollars you're costing yourself by having that mutual fund with professional investors. And the most disturbing part of all is, I believe I read the stat once, 82% of mutual funds don't even beat the stock market, the S&P 500. So why even spend the money doing that? Yeah. In terms of individual stocks, guys, this is tough, but what makes individual stocks tough? It's not the fact that it's the numbers. The numbers are the easy part. It's the emotional side of it. The best investors ever have the greatest ability of being calm when everybody else is being frantic. That takes a brainwashing. That takes a certain person. I'm a highly emotional person in general. However, when it comes to investing, I am extremely calm about things. I can sit there and say, well, yeah, everybody's wrong here. 08 and 09, buying real estate like crazy. I have proof I was buying stocks like crazy, unlike everybody out there who now claims they were. I actually have proof of it. Whenever I ask others to prove it to me, I get, yep, I'll get it to you, never hear from them again. So, in order to invest individually in stocks, it's very possible. And you can easily it's actually not very hard to beat the market. But the reason people don't beat the market is their emotional side. When stocks go up, they want to buy the highest flyers. You know why? Because when you're buying individual stocks that are good value, they're not going to do as well as the high flyers. But when stocks are going down, these things go like that, and these ones go like this. So the hard part about buying individual stocks is the emotional part of it. If you're okay with the ups and downs of stocks and being potentially wrong, you can create your own ETF essentially with stocks, right? Pick some sort of valuation metric that you like and find 20 or 30 stocks that match that, and you basically created your own ETF. But you got to stick with it year in and year out and don't deviate. That is the hardest part about buying individual stock. That's the same thing with ETFs. If you see an index crash, you might be like, oh my God, I don't want my money going to zero. I'm going to sell this stuff. No, be calm. It's about the long run. You buy here to not even think.
Yeah. Another great benefit of ETFs is that they really mitigate risk. I mean, if you have Apple moving up or down 5% in a day, you're not going to catch plus or minus 5%.
I'm going to correct Mo. You mitigate volatility.
Thank you.
Risk,
good point.
Risk is purely the price you pay.
Yes, good point.
If a stock is worth 10 and you pay 5, it's less risky than if you pay 15.
Yeah.
It's still the same stock. So risk is all about price, but volatility, it helps reduce volatility for sure.
Yes.
And that's a great way for most people claim when times are good that they're okay with risk because they don't see downside measures, right? But last year during COVID, we saw in 1 month stocks go down 40%. A lot of people are freaking out, and then it skyrocketed and doubled from there. We're actually doubled where we were in March of last year.
Know.
Isn't that nuts?
I was talking to my father about it. I said, because he told me, he was like, you guys are really sleeping at the wheel back in March in 2020. And I said, Dad, you would look at everything in the economy right now, jobs, people aren't working, everything's bad. But you would have predicted that stocks would have gone up however much.
Everybody's a Monday morning quarterback.
That's what I said.
But then right now, and the funny thing is, there'll be Monday morning quarterbacks in a few years and they say, well, obviously the stock market was overpriced in 2021.
Exactly.
I mean, look at it. We just came off pandemic. Yeah. Stocks had doubled. Tesla was making barely any money and selling for $700 billion. These SPACs are going public with no revenue. It was obviously overpriced.
Yep.
Yet when I'm out there right now, I had a friend in town this weekend. We were talking about WeWork.
Yeah.
And I said, I'm like, oh yeah, that was pretty, I was like, yep, but everybody thought I was crazy when I said WeWork. I was like, and they said, well, everyone thought it was crazy. I'm like, no, Not everyone thought it was crazy. That's the point. In hindsight, everybody looks at it and goes, that was crazy. But and by the way, remember what they're saying about WeWork? It was a tech company. It wasn't a real estate play.
Of course.
How? It was a real estate play.
Yeah.
So the point is, when you're going back to this, ETF is what I think you should do for your long run retirement.
Yes.
Right? Just stick money in there every single month, same process until you retire. Stocks, take 5 to 20% on the high side of your money and buy individual stocks. But don't do it until you have a process. If you're gonna do it just buying hype, you will lose in the long run. You will not make as much money. You think you're gonna be different? Congratulations, you will not be different. I have my friends always tell me the statement, it's about time in the market, not timing the market. And they're correct for the average person. For me, no. I enjoy sitting here and waiting with all cash, waiting for the right time to buy. I'm not all cash, I'm like 93% cash. But the point is, I will wait till I'm blue in the face for the right time to buy, because the second it's the right time to buy, and is it gonna go lower, I will pounce on it and everybody will be telling me, you're crazy, I'll be buying.
Why should I not employ that strategy? Because I know we just had a great video last week about stock market crash warnings. Some of our patrons were saying, oh my, should I, especially if they were buying ETFs like SPY, why don't I sell right now at the high point? Hold on.
I've been saying it's been high for a long time now. You can never time these things. The average investor will always time it wrong, right? Sorry, everybody's gonna time it wrong. I'm gonna get the timing wrong. But I have the discipline when things fall of buying more. When everything looks like it's the worst thing that could possibly happen, buying more. Like CCL, we were buying CCL last year. It could not have looked any worse, right?
Yep.
Could not have looked any worse. And we've doubled our money since then, and we still think there's upside left to it.
Southwest couldn't have looked any worse.
Oh yeah, Southwest.
Couldn't have looked any worse.
That one was even crazier. That one doubled in a matter of like 7 months. And I was like, it went basically to my value when it was, this is an example of how stocks are crazy. I bought at 25 on the nose, 25.00. I sold at 47. I had a value of 55 to 60. So I'm like, you know what? We aren't even back yet traveling. I'm just going to sell this thing and wait for a better time to buy. So these are the things that we have to understand, that everybody thinks they're smarter than they actually are. I'm sure including me. But being in the market's very possible with stocks. And even on ETFs, we're not all about ETFs. If you have a play that you like, let's say, for example, you go, you know what? I think the travel industry has been hit too hard. I'm going to buy jets for the travel industry. You're not going to do it individual. It's a good way to make an investment and make a bet on a sector that's been hit very hard without having to worry about the individual companies within it. Will you make as much money? No, but you'll still be able to get outsized returns by making a bet on a sector in a low-cost ETF.
A question that I get a lot and that I want to emphasize is, when it comes to ETFs, people ask me, this is going back to the conversation we just had, should I not be investing in ETFs now? Should I hold cash until a pullback happens or something? No. The same amount every month over the 40 years of your career until retirement or whatever. Please do not deviate from that. Do not try to time the market. You will be, yes, you're going to get hit, but when it's also really low, that's when you're going to be buying cheap, and it's all going to balance out. Plus, you're going to collect the dividends over time. It's going to work out for you.
This is a chart of where the stock market will go over long periods of time.
Yes.
This is where you're going to buy.
All of it. Exactly.
And the reason being, you're going to overpay sometimes, you're going to underpay sometimes. You're going to overpay, you're going to underpay. Overall, though, this is what you're paying.
That line. Yes.
And it takes the emotion out of it.
If you try to time the markets, you are going to never hit that line going right through the middle.
Yep. You'll always end up with less money. Now, here's the good news. Your financial planners will be fine with that, because when you wake up 40 years later with 7 times your money, you'll be like, oh my God, I have 7 times my money. You should have 15 times your money. That's it. So stick to the ETFs. Cheap way to get yourself in the market and basically beat all the professionals 82% of the time while also not paying the fees.
So why do you not buy ETFs like ARK or Buzz?
Good question.
So that's the exact example of every ETF has a certain sector they're focused on. ARK sector is companies that don't make money. It's all the hype stocks.
And frankly, those are wolf in sheep's clothing. Those are not ETFs.
Even though we love the guy who created the Buzz ETF.
I love him.
David Portnoy, Michigan guy, go blue, but
those are a basket of stocks under the guise of being a traditional ETF, and they're just not ETFs. Just because it's a basket of stocks shouldn't mean that it goes under the definition of exchange traded fund. It just shouldn't.
Well, no, it's still exchange traded fund.
Technically it is, but
not technically it is. It's not the safety.
It's incredibly deceiving.
Well, because people think diversification just means if I hold 20 stocks, then I'm diversified. Yeah. Well, if you own 20 of the most ridiculously overvalued companies, you're going to be hurt, right? It's just the way it is. That's just reality. And I think we looked at ARK's top 20 holdings, 17 lost money.
With those, there's no mitigating volatility in there. The whole basket is volatile.
Correct, exactly. When the whole basket is volatile, and they're all correlated.
Yeah.
They're all correlated. Yeah. The most overhyped companies do the best. They also crash the hardest.
Right.
Guys, tickle a thumbs up. If you like our community, patreon.com/everythingmoney. You can get our software, 80 cents a day. You'll get stock analyzer tool, 8-pillar software. It'll do all the work for you. 10Ks, the Discord chat with over 3,800 people in it. The app comes out. It's out right now. iOS and Android app on your phone. You can use our software. You don't have to go to the computer. This is awesome. This is incredible. Sign up. Thanks very much, guys. And I'll talk to you later.
See ya.